Yash, for that. But we're just counting down. I think we have about 10 minutes left for what has been a rather lackluster day of trade, one where the Nifty has just given up about 80 odd points and the Sensex is down 280 points. So after yesterday's big bang somewhat opening, the market has sort of given back a little bit of its gains. But that could also be because tomorrow is a holiday and people may not want to leave any positions open. Devina Mehra is joining in. She's the founder, chairperson and managing director at First Global. Devina, happy Diwali to you and hope you have a great year ahead. I remember we spoke on the Smart Money show a while back and you were quite bullish on the markets, especially in the context of India doing so well compared to its global peers. Do you think a large part of that outperformance has played out already, or do you reckon that there could be more?
Happy Diwali, Sonia, to you, the team, and to your viewers as well. And very happy new Samvat. Yeah, I mean, I've been talking about India outperforming for a while since at the end of last year. I was expecting that this year India would outperform, which it has done. So as of September end, I was looking at the data. So out of 42 country indices, we are number 8. We were still negative in dollar terms because only 4 or 5 countries, primarily those with a commodity bent, were in the green, but we were way above a whole lot of others. So yes, I think the outperformance will continue, and part of the reason for that is that there was a whole decade, 2010 to 2020, where India both underperformed relative to the rest of the globe. You know, those days we used to be number 24, 25, that kind of range most years, and relative to its own history. So that long-term return of whatever we have in mind, that Indian equity markets return 15, 16%. For that decade, it wasn't even 9%, it was 8 point something, and those days, if you remember, the fixed deposit rates themselves were 8% plus. So equities gave you no advantage for the extra risk taken. So once that tide turned, that you began to go up both in absolute terms and relative to the rest of the world, I was quite clear that that outperformance would continue, and which is why the risk of a crash also becomes less, because you know the big crash comes when you are way above the trend line. If you are still reasonably below, that risk is limited. So yes, I mean, overall I think India will continue to outperform. Even now we think it is one of the best global markets when we look at the countries.
Well, we take that point, and you know, the data also suggests that we're some of the best placed in the world right now, Devina. But you know, the question is that what leads this outperformance? If you're betting on the domestic economy outperforming as against the global weakness right now, how do you play it? Do you play it via the banking system? Do you play it via consumption? Do you play it via autos? I mean, how does one go about it?
See, we look at pretty much all sectors and countries. So in terms of broad trends, I'll tell you right now, our systems are liking small and mid caps a bit more than large caps than has been our base case. It's still, we as a house in terms of our portfolios don't go too much into small caps, because there is also the risk element, and we are always driven by risk management first. But coming to your question of where are the pockets? See, one thing which you have to realize is the economy and the market are two different things. So it is not that everything is great with the economy, but the parts of the economy which have been doing well have been the upper and upper middle layers. So there is still a lot of issues at the lower end, because you see that offtake of free rations, or you look at number of people looking for Narega jobs. All of those show that there is still reasonable distress in the economy, though I mean things have improved in the last 2 quarters, but even so. But there has been a move over the last few years to the more organized sector, which helps the listed space. What also helps the listed space is that a lot of the companies do cater to the more creamy layer. You know, if you look at real estate, right, they are not going in rural housing. So given that, the sector-wise, if I look at the last 1 year, the sector we've been most overweight on has been capital goods and industrial machinery. And that still continues to be our most overweight sector. So that came out of a very bad 10, 12-year period where it did nothing. I mean, and then there was a demand turnaround, which had elements of the PLI, government capex, China plus one, whole lot of things. Plus, they were, the companies were lean and mean because of that prolonged downturn, and the valuations expanded. So that's been a big winner. It still remains overweight for us. Things where we have added in the last couple of quarters have been auto four-wheelers, auto components, couple of FMCG names. We would be overweight FMCG. Textile and chemicals, we would be overall overweight, but those are not sectoral plays. Those are very specific company plays, because the dynamics in those sectors vary very widely company by company. So those, and you talked about banking. Now, banking is a sector that I rarely, if ever, like, because I think it's a highly risky sector where negative surprises spring out of nowhere. But it is cyclically at a good point. The NPA problems are behind you. Credit growth is good. When interest rates go up, your net interest margins expand, at least in the beginning, because your loans get repriced and deposits don't. So from
Devina,
being very, very low weight, we would be market weight banks now.
Okay, all right.
Not overweight still.
Okay, all right. Devina, first season's greetings to you, and thanks so much for joining us. Nigel on this side. So you've told us you're fairly constructive on the manufacturing theme as well as industrials, and that seems to be a space that could do well from here. My question to you is, what is the biggest risk for our markets according to you besides valuations? And also give us that one theme, what you're cautious on. Constructive, you've given us a couple of themes already, but what will you be cautious on from here on?
I mean, most of the rest of the things we would, even textiles and chemicals, as I said, it is fairly company specific. FMCG is fairly company specific. Pharma had a good phase when the market was a little bit in turmoil, but barring one or two companies there, we don't like that much. We don't like real estate very much. So those would be the things. So, but we have a fairly diversified portfolio at any point. So it's not never as if we are in only 3 sectors or anything like that. So that is very much there. In terms of the big risks, crude is mostly, known and priced in. Most other commodities have come off their highs, so I don't see a big risk there. As I said, on our own economy front, which is a more medium-term risk, we have not crossed our per capita income of 2019 still. We are still very, very short of jobs which you should be generating. So if I talk of, we all love to talk of the demographic dividend, but the demographic dividend has 3 components, which is working age population, people who are actually working, and productivity. So we have the first one, but we don't have the other 2. So, and this is available to you only for a limited number of years, that people coming into the working age population, but youth unemployment is extremely high. So, those are the things which concern me, but those are not like 1 quarter issues.
All right, got that.
Those are more.
Sure, got that. Devina, we're actually heading into the closing for the day. So we thank you for stopping by and speaking with us on this auspicious day. The start of a brand new year as per the Hindu calendar. So hopefully all your views will come true and this market is going to reach new heights by the time next Diwali comes through. Thanks a lot for joining in and have the best year ahead. Happy Diwali once again to you and your family.
Thank you and happy Diwali.
All right, let's do one thing. Let's slip into a quick break. When we come back, we'll get some market talk going. We'll wind up the day's trading action as well. It's been a little bit of a disappointment for the bulls, nothing alarming, but the Nifty down about 86 points. Stay tuned.